Good Wednesday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's such a pleasure to be with you. I hope you're having a great day. Halfway through the week already. I can't believe it. Just a few more days to go. All right, folks, thank you so much again, as I said, for joining me today. Heck of a day today. Record-setting session again for the NASDAQ, a record-setting session for the S&P 500. No complaints on this end. Things didn't go well. A couple more ships taken over by Iran, oil prices running up. I mean, what could have been normally bad news? We just brushed it aside. It's focusing now on earnings, our next new Fed chairman, all the things that we normally would be worried about or happy about. That's exactly where we are. So I will give you the market recap. But first, let me tell you what I have in store for you after that event is taken care of. I'm going to talk about a subject that is very hard for many of you to discuss. But it is something that must be discussed because the odds are, I hate to say this, the odds are that most people, over 50%, based upon the latest stats, will end their marriage in a divorce. I know it's staggering. It's heartbreaking. A divorce can break your heart, but it can also absolutely break your finances. That is if you're not prepared. Even if you are prepared, there's going to be pain. I'll tell you that. Today, what I'm going to be doing is I'm going to be talking about what I like to call the real numbers behind the divorce in America. Which groups are affected? The biggest financial mistakes I see people make during and after a divorce. And most importantly, how do you rebuild after this life-changing, devastating event? And I know some of you are saying, wait a minute, life-changing, devastating, what are you talking about? It was the best thing in the world that happened to me. Well, that is wonderful, and I'm glad for that. But there's a lot of people that, again, maybe they're happy being away from their former spouse, but the financial reality is it's painful. I don't know of anybody that ever gets out of a divorce going, hey, that was just great, and man, I walked away with everything, and, on and on. It doesn't really happen that way. But again, it's something that's becoming very prevalent. And what was really interesting when I was doing my research on this topic was how high the divorce rate is for the younger generation, the 20s to 30s. Matter of fact, they've now exceeded all other demographics when it comes to the divorce rate. Because, you think about it, it's tough for young people these days, right? Obviously, you're married, you're trying to adapt to living with somebody else and all the changes that every one of us have gone through in a marriage. And then, of course, you got the financial strains, right? It's tough for young people these days. And so the financial side, which is always the number one reason, not infidelity, nothing else even comes close to the number one reason for divorce, and that is money. Right? And again, let your imagination wander. Maybe one person has a spending problem. Maybe one person, I had a client years ago that he came in and said that he's divorcing his wife. And of course, I asked why. And he said, well, because I just found out she had $75,000 of credit card debt that I didn't know about. And I'm like, devastating, but is that a reason for divorce? And he said, the debt was incurred because of gambling. She's got a gambling problem. I've dealt with it for years and I can't do it anymore. So this was the icing on the cake. So again, money reasons are always number one for reason for divorce. But what we need to do is we need a plan. Not that I by any means want this to happen to any of you, but if you're in the midst of it, you're thinking about it, there's many things that you need to be prepared for. And that's what I'm prepared to help you do, right? We're going to be talking about the income shock, the asset division confusion, as I call it, the retirement damage. Oh, is that ever a situation? Insurance gaps, estate planning problems, emotions when it comes to decision-making on the financial side. So there's a lot of different things, again, that we need to cover, and I will. And so therefore, I'm going to shut up and get down to the stock market side of things so that I can get to that topic and help you out there. All right. How do you summarize today? Well, like I said, market had every reason to pull back a little bit. Like I said, a couple ships taken over, oil prices going up, but it just brushed it aside. We actually finished, like I said, with a gain of the Dow, a gain of the NASDAQ and the S&P, the latter two record closes. Here's the final numbers. Finished up 341 on the Dow, a 0.69% gain to 49,490. Oh, just a couple strong days and we're back to that 50,000 mark again. Then I'll be saying, hey, you know what? Dow's in record territory. The NASDAQ surging again, 398 points, 1.64%. The S&P rose 74 points or 1.05%. So strong across the board. Oil prices, they were strong, $3.45 increase to $93.01 a barrel. Gold, a decent day, $34.70 increase, $4,753.80 an ounce. And the bond market, man, I would not want to be a bond trader right now trying to make a living because things just are not moving. Another day where we just closed unchanged on the 10-year treasury yield, 4.29%. So it was a very lackluster session there. So all the stars lined up. You got the bond market behaving itself, and other than the oil prices running up, everything else looked really really strong across the board. So we did get some great performance on the Dow side of things thanks to Boeing. Now they reported a loss, but the loss wasn't as big as everybody thought it was going to be, meaning the analysts. So Boeing just took off today, 5.5% gain, up $12.12, 231.28. So that helped out the Dow. Another big star today was GE Vernova. Boy, this stock does not get enough talking about. One of the spinoffs of the old GE days. It's a high price stock, $1,126 and a penny, but listen to this number. Shot up $134.71, 13.59% gain. And so that was fueled again by stronger than expected earnings numbers. Masco, $7.19 rise, 10.77%, another standout, closed at $73.95. United Airlines, though, stocks were down a little bit. United Air down $5.42, 5.58% to 91.71. They cut their full year outlook due to a large part, in large part, I should say, to, of course, rising fuel costs. So I'm sure you're probably going to get other airlines. Now, speaking of airlines, maybe some of you have traveled on Spirit Airlines. I did the last time that I traveled, and I swore I would never do it again. It was the most miserable experience I ever had. And all of you know I hate traveling, and that made it even worse. But here's why I'm bringing that up. The Trump administration is now saying that they're contemplating, and I think it's probably going to happen based upon what I'm hearing and seeing, they're going to bail out Spirit Airlines to the tune of about $500 million. So haven't seen the exact structure of it. I would imagine when we bail out other industries and other companies, we take ownership in them, kind of like what we did with Intel. But I just wonder, every time this happens, I just sit back and I go, man, I would be so upset if I was a rival CEO and the government came to the rescue of one of my competitors. I mean, we all know, those of us that have been around the block for a while, we all know how many times have these airlines gone bankrupt. But mysteriously, miraculously, they all rebound and they go on to make billions and billions of dollars. But I have to admit, unless a company is vital to, let's say, the defense, the security of our country, or something along that level of importance, I personally have a problem with the government coming in and bailing out a company. I really do, especially Spirit Airlines. They created the bed that they're lying in right now. And I won't go into all the details, but they were poorly run for many, many years. Tried to do mergers and acquisitions that didn't work out, blew things up. But yet our hard-earned taxpayer dollars are going to come in $500 million and bail them out. Like I said, I have a hard time every time the government announces a bailout of a company. Again, unless it's so critical to our U.S. economy. For example, I could see Boeing as an example, right? We need that company as a country, as an economy. We need them. And, if that company got them, Lord knows they had their share of problems, but they seem to be righting the ship, as the saying goes. And so let's say they weren't and they were drowning and falling and falling. If the government said, okay, we're going to come in and buy a portion of you and support you and provide some capital, I would have no problem with that because that is a company that is vital, in my opinion, to the U.S. economy, to the industries, et cetera. But in airlines, I mean, Lord knows there's enough of them. And I don't know. Like I said, I just have a problem with that one. But we'll see what happens. Again, details are still kind of sketchy on it. Let me jump over to, they did report earnings numbers after the close. I will get you the exact numbers. I did not get a chance to look at them specifically, but I was just, a moment ago, I was just checking the stock in the after-hours session and really was not budging much whatsoever. Let me give a fresh quote on that one for you here real quickly. Yeah, it was slightly positive as the intro music was beginning, but it down $1.71 right now in the after-hours session, 0.44% loss to 385.80. This came about after a $1.09 gain in the regular session. Finished the day at $387.51 a share. While I have that up, I might as well let's just jump right into the numbers here. Yeah, so here it is. They had a miss on the revenue side. Let's see. They initially rose about 4%, but yeah, obviously not there now. So earnings came in at 41 cents a share. Expectation was 37 cents. Revenue, again, a slight miss, 22.39 billion. Estimate was 22.64 billion. So let's see if there's anything else. Revenue increasing 16% to 19.3 billion compared to a year ago. Auto segment revenue rose 16% to 16.2 billion from 14 billion a year ago. Well, I tell you, you look at a scary chart, you look at their total income, where they were and where they are, man, we are way, way down. Like from looks like this was fourth quarter of 2023. They had 7.93 billion in net income, which was way above normal. I don't remember if there was some unusual event, but yeah, 7.93 billion. Like I said, fourth quarter. Now it's 47.7 million. So look and see how far they have dropped there. So, anyways, like I said, I won't waste much time on this because the stock's just hardly budgeting on that. Okay, you are now up to date. I'll come back. I'll tell you what the gold and bond market did today. Like I said, unchanged on Treasury. I'll tell you what gold did. And then we're going to get into our topic. Divorce and your money, the final or the financial reset that no one prepares for. Let's wrap it up, or turn it over, I should say, to Kristen Snow. Back to the Jon Sanchez Show on Newstalk 780 KOH. Again, a record-setting day for the NASDAQ and the S&P 500. We'll get to our topic, divorce and your money, just in a moment. Finished up 341 on the Dow. The NASDAQ gained 74. The S&P higher by 398 points. My goodness. All right, let's get to this topic. Again, tough topic to talk about, but something we must deal with because the odds are, not in your favor to stay married, unfortunately. There's more than a 50% chance that you're going to end in divorce. But, divorce is probably one of the most emotional things that a person can go through. I liken it almost to the same pain that you go through when you lose a loved one. But it can also be one of the most important financial turning points in your life. The emotional pain is obvious. The financial damage often hidden until it's too late. And that's why today I'm going to talk to you about the challenges and the solutions. Because while divorce may end a marriage, it does not, and let me repeat, it does not have to end your financial life. Not at all. I've had many clients over the years that felt absolutely financially devastated when the divorce was over. And then lo and behold, a few years go by, they're right back on their feet and they just continue on. And that's because they had a good understanding. They planned for it. They understood the whole process. So between now and when I go to break here at the bottom of the hour, I want to go through basically 10 divorce statistics, and then we'll get into some solutions and things you need to be thinking about if this unfortunately happens to you. Because it's again, very, very interesting to look and see where divorces come from and so on and so forth. So let me get down to the data. Most recent data that I could find, I'll tell you, is 2024. I was stuck on 2022, and finally I found some sites that had some updated, i.e. 2024 data. So this is the latest that I can give you. But okay, so as of 2024, the U.S. divorce rate remains between 40 to 50% for first marriages. But that number, here's the good news, has steadily declined over the past few decades. In fact, according to the CDC, the divorce rate in 2021 was 2.5 divorces for every 1,000 people, significantly down from earlier years. Now, this shift can be attributed to changing social norms, an increase in the age at which people first marry, and better relationship education. Okay? Marriage duration before divorce. So how about this? On average, a marriage that ends in divorce lasts 8 years, according to the U.S. Census data. However, this varies significantly based upon factors like age, education, which I'll cover in a moment, and geographic location. That's right. Where you live, how you're educated, it has a big impact. For example, states like ours, as well as Oklahoma, have consistently higher divorce rates compared to states like Massachusetts and Illinois, where the divorce rates are much lower. My third point, second marriages and divorce. This is a staggering number. The likelihood of divorce increases with subsequent marriages. Around 60 to 67% of second marriages end in divorce, compared to, as I said, 40 to 50% of first marriages. Now, this trend is even more pronounced for third marriages, where the divorce rate is 70%. Now, these stats highlight the challenges that come with blending families, managing more complex financials, emotional situations in later marriages, etc. The gray divorce. One notable trend is the rise of the gray divorce, which refers to, of course, divorce among individuals age 50 and older. Since the 90s, the divorce rate for this demographic has doubled. According to the National Library of Medicine, gray divorce can have significant financial and emotional impacts, particularly on women who are more likely to face economic hardship after divorce. Speaking of economic hardship, how about this one? The financial impact of divorce. The financial cost of divorce in the United States varies widely depending upon, of course, the complexity of the case. Now, according to Forbes, the average cost of a divorce in 2024 ranges between $7,000 to $15,000. But this figure can increasingly be more significant in high conflict cases of those involving substantial assets. Additionally, the economic consequences of divorce can be long lasting, with many divorced individuals reporting decreased income and financial security post divorce. Another interesting stat, number 6 point, divorce and education level. Education plays a key role, and I didn't realize this till I dug up this stat, plays a very key role in the likelihood of divorce. Individuals with a college degree are 30% less likely to divorce compared to those without a degree. Higher education often correlates with better communication skills, financial stability, and delayed marriages, all factors that contribute to stronger, more resilient relationships. Like I said, didn't know that one. The impact of divorce on children. Well, having children, of course, can delay or complicate the decision to divorce, but it doesn't always prevent it. Approximately 40% of children, almost half of children in the U.S., experience parental divorce by the age of 18. Additionally, the U.S. Census reports that single-parent households, often formed after divorce, are on the rise, with nearly 19 million children living with a single parent. My 8th point, religious and cultural influences on divorce. This is another interesting one. Religion can have a significant impact on marriage stability. According to the Pew Research, individuals who regularly attend religious services are 14% less likely to divorce compared to those who don't. In contrast, those without any religious affiliation experience higher divorce rates, with around 50% of religiously unaffiliated marriages ending in divorce. Additionally, cultural attitudes toward divorce differ widely. For example, certain communities or religious groups, as we all know, may look at divorce as a last resort, influencing both the likelihood of divorce and the stigma that is attached to it. All right. How about if you lived with your current spouse before you got married? Listen to this one. Couples who live together before marriage often experience higher divorce rates. That one shocked me too. I thought it'd be the opposite. According to research from the Institute for Family Studies, couples who cohabitate before getting engaged are 39% more likely to divorce compared to those who do not live together before marriage. The trend highlights the importance of clear expectations and compatibility discussions before cohabitation. And these factors often play a critical role in long-term marital success. And then finally, my 10th point, the role of prenup agreements. Well, prenups were once considered just for the wealthy, not anymore. A survey conducted by the Institute of Divorce Financial Analysis found that 63% of certified divorce financial analysts professionals believe that prenups help reduce the likelihood of contentious court battles during divorce. Additionally, prenups are especially beneficial for second marriages, i.e. the blended family, higher wealth, etc., where individuals often have more assets to protect or children from previous relationships to consider. Okay, so there's the stats. So what do we do with all this? How do we prepare for it if this unlikely, or I shouldn't say unlikely, this likely event happens? I've got the answers for you when we come back. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hello, Jack. The Jon Sanchez Show on News Talk 780 KOH. Happy a Wednesday to all of you. All right, once again, a record-setting day for the NASDAQ and the S&P. NASDAQ finishing up 397 points, 398 to be exact. Rounded up a bit, 1.64%. S&P rose 74 points, 1.05%, and the Dow a 341-point increase. All right, we're talking about a very difficult subject to discuss, but one that must be, and that is divorce and your money. So I'm going to continue on now with getting into some things that you may encounter in a divorce. Very, very common that we see among our clients and people I've known. We're going to start with the first one. I'm going to title this the challenges the divorcee faces. Okay, the income shock. Now, many people will go from, let's just say, a comfortable lifestyle, right? You got maybe two incomes or maybe one income. You got a stay-at-home spouse. I can't say it's a wife anymore. Sometimes it's the man, but you're comfortable, right? And then the divorce happens. Now, guess what happens? One household becomes two households, same income base. Now you've got two rents or two mortgages, two utility payments. Maybe you have to go get another car. You got two insurance setups. You got basically two separate lives. So what we see happen a lot is one of the spouses generally, sometimes it's both, again, end up taking a reduced lifestyle, as I call it, because they can't, they've got just one income now. And especially if that spouse, like I said, was a stay-at-home person, they've got to go find a new job. They got to basically start a new career. Really, really tough for people that have been out of the workforce for any number of years, especially as fast as things are changing due to AI. So it is an income shock, to say the very least. And I'll just kind of rephrase that and really call it a lifestyle shock, right? It's very, very difficult to go from being comfortable in a two income or two person household, and now everything is basically, like I said, double in cost. Let's go to the second challenge. The asset division confusion. Emotions, as we all know, fly extremely high during a divorce. And the most ridiculous things in the world can be fought over. No, I want that painting. It has no value, but it has sentimental value to me. No, I want that one. And you end up fighting the person. Well, remember, that clock with that attorney is clicking and ticking every time that attorney has to hear this or give you advice on that. So what may be a worthless asset, like a painting that really has no value, just emotional value to you, may end up costing you thousands of dollars in attorney costs. So it's very important not to let your emotions get the best of you in the midst of a divorce. People focus too much on who gets what, really kind of the revenge factor, right? But not whether they get it in equal value. This is another issue, the after-tax value. So many times we are dealt with, we get a divorce decree, and let's just say it's Sam and Mary, right? And the divorce decree, which is very typical here in Nevada, says, all right, you got to split that 401k or that brokerage account 50-50. Well, the question then boils down to, well, okay, if you got a portfolio of, let's say, a bunch of stocks, who gets what, right? Let's say you got a portfolio of 20 stocks. Do you just split it right down the middle and say, you're going to get the first 10 and Sally's going to get the other 10? No, you can't do that. So this is where it gets really messy. And as a financial advisor standpoint, there's no way of knowing again in the future, out of those 20 stocks, which 10 are going to do the best, which 10 are going to do the worst. So what we generally will recommend, assuming taxes are not an issue, so it's really easy in a retirement account or a 401k, liquidate the darn thing and let each spouse start over. Because you got to remember too, post-divorce, you're going to be in a different financial situation. Your risk tolerance, your goals, et cetera, are probably going to change. So very good likelihood that those investments that you owned while you were married are not going to be appropriate for you while you are divorced. So keep that one in mind. But remember, you got to look at the after-tax value. I shared a story with you guys, a month or so ago. I got a call from a client, it wasn't long ago, 6 months or so ago, and said, he got a divorce. It was 17 years ago. And it's kind of hard to believe, but, I believe the guy, and, got a divorce. Had a nice 401k, about $500,000, or actually it was about 300,000 at an employer. Got a divorce. She was supposed to get half of it. Well, somehow, some way, he didn't bring it up to her, and she and her attorney forgot about it. And all of a sudden, out of the woodwork, 17 years later, here comes basically the attorney, writing a nasty letter saying, you owe my client, which was 300,000 at the time of the divorce, the current market value. It was now worth 500,000. So he was devastated. Now, should he have known and brought it up? Probably. And I told him that. But those kind of things happen, right? And so you always have to look and see the future value of the investment. If things are going to be sold, who's going to pay the taxes, on and on and on. And I'm going to get to the tax side of things because you got to be really careful of what you do when it comes to the home. But even on a taxable brokerage account, if you're going to sell it, are you going to sell it post-divorce or pre-divorce? That's something you have to make a decision on. Third point is the retirement damage. I can't tell you the damage that is done to people, and especially if it's the great divorce, age 50 or over, because you are getting into the prime in the final years of your highest income earning years. You've done a great job saving in the 401k, and then all of a sudden you're going to lose half of it to the spouse. Where does that leave you? Are you going to be essentially starting over? I mean, maybe you had maybe you had $1 million 401k, and now you've got a $500,000 401k. Well, let's look at the numbers, right? If you do a 6% withdrawal rate on a $1 million portfolio, that's $60,000 a year you were looking at when you were married. Now you got a $500,000, 6%, that's $30,000 a year. So significant impact to your retirement. Many times I see with clients that again get divorced later in life, they never end up retiring. They can't afford it anymore. So you got to keep that in mind and do some really good negotiations in the whole entire divorce process. Same thing comes to, pensions, Social Security strategies, savings. I mean, anything, it all has to be factored in. And what I've seen, and this isn't to bash attorneys or anything like that, but you need to be very careful when you are selecting an attorney to represent you in a divorce. You need to be very careful that you are selecting an attorney that has some good financial knowledge, experience, because I've seen a lot of attorneys over the years that they had no idea. They didn't understand present value versus future value. They didn't understand Social Security or pension strategies or anything along those lines. And they'll just say, all right, you're just going to lose half of it with no strategy behind it. So you got to be very careful. There are people that you can hire, sometimes a CPA, a financial advisor, if they're a fee-only advisor, you can hire them to counsel you and guide you through that entire process, because you're talking significant sums of money and you don't want to make a mistake. I've seen it way too many times. Next one is the insurance gap. This is another eye opener when divorce occurs, right? You're maybe on your husband's insurance policy. Well, guess what? You're divorced. Now you're not. Now you got to go out and buy your own insurance policy, or see if your employer, if you are going to go back to work, does the employer offer that? Health insurance is a big one. Life insurance is a big one. And especially, as I always recommend, and when we talk about estate planning, you need to make sure that you check your beneficiaries after that divorce is over, because most likely you had your ex-spouse as beneficiary on life insurance, IRAs, 401ks, etc. But life insurance, disability protection, all that needs to change immediately after the divorce. Now, speaking of the estate planning problems, boy, I tell you what, this is the time that you want to sit down and have a thorough review of your wills, your trust, your powers of attorney, healthcare directives, financial directives, everything along those. And as I said, the beneficiary designation, because all of that's going to change. That trust that you had when you were married, no good anymore. Right? It's no good. So you have to go get a new trust, or whatever your estate planning is going to be. But that trust that you had when you were married, no bueno anymore. So you got to do something about that. And that, again, got to be another cost to have another trust or estate plan created. And then the emotional decision side of things, this is where it gets so tough. As I said earlier, the worst financial decisions are made right in the middle of the divorce. And again, especially if you have an attorney egging you on, most attorneys will kind of play it down the middle and say, okay, calm down a little bit. Let's really see if this makes financial sense. But, your emotions are going to be running very high. You're losing the spouse you've been with for many, many years. If there's children, that's another emotional side of it that I'll discuss when we come back from the break, but also the financial side of it. So there's a lot of things going against you mentally during a divorce, and we tend not to make the best financial decisions there. So that's why, again, you want to bring in a team to have cool heads and really look out for the best of you and in your future. Because, like I said, one wrong mistakes, having one wrong sentence in that divorce decree can really devastate you for the rest of your life. All right, the financial moves every divorcee needs to make. I'm going to cover those and wrap it up when we come back. Speaking of it, now I can say, Kristen Snow, wrap us up in the Right Now Traffic Center. Back to the Jon Sanchez Show on News Talk 780 KOH. Divorce and your money has been my topic. Let's get down to the final pieces of this. I've titled this next segment, The 5 Financial Moves That Every Divorcee Must Make. Okay, number 1, build a new cash flow plan. Right, as I said earlier, things have changed dramatically. Incomes have been cut, assets have been split, everything has changed. So figure out what life is going to cost you now, post-marriage. Not what it used to cost you when you had 2 people sharing expenses, double incomes, so on and so forth. I see this happen way too often. People try to live post-divorce the way they lived pre-divorce. And obviously, in most cases, that does not happen. So a brand new cash flow plan is a must sooner rather than later. Matter of fact, even when you're going through the divorce, if you got a good idea what this final settlement's going to be, do it then, so there's no shock and no time loss post-divorce once you sign that decree. Secondly, separate the emotions from the economic side of things. Don't, as I said earlier, don't fight for an asset just because it feels symbolic, just because you're trying to, get retribution against the ex. Don't do that, because it ends up costing you in the long run, not only emotionally, but like I said, a lot of times I've seen it with people. They'll fight for something that has no value, and before you know it, they get an attorney bill for a couple $1,000s, and what they were fighting for was, worth $100 or worth nothing whatsoever. So be very careful what you fight for. Number 3, I wish I got to do an entire show on this one, because I feel bad just telling you the high level of this. But the taxes, right? Review the taxes before you sign anything. Pre-retirement money, home equity, alimony rules, filing status, capital gains, all of these things matter. I'll give you one little tidbit that is very important that a lot of people don't know about. You have a primary home, right? You're married, you can sell it, and you can make a $500,000 profit. That is, if you're married. But there are very specific rules that obviously I don't have time to go into about what happens if you sell it after divorce. You got the living there 2 out of the last 5 years, so on and so forth. But things get really messy. The judge, let's say, gives it to one spouse. Here's where things can, just a little tidbit I'll share with you. Many people don't know this, but if that home is transferred to one spouse, let's just say to the wife, she's the recipient. Guess what? She's also the recipient of the cost basis on that house. So now she only has a $250,000 tax exclusion, not $500 like when she was married, but now she has the same cost basis as if she was married. So again, a whole nother set of rules and things you have to follow for the retirement accounts, the house, other assets that have capital gains, etc. Very important you understand that and have a good accountant behind you or a financial advisor. Number 4, update every legal document. Beneficiaries, wills, trusts, powers of attorney, medical directives, financial power of attorney. You got to update everything. Like I said earlier, if you don't, that trust that you may have had when you were married, it's invalid. The medical directive, invalid. The financial power of attorney, invalid. The pour over will, invalid. Plus, it has people in there that you probably don't want, i.e. your ex-spouse. So meet with us, meet with anybody to get that trust and that estate plan created and done correctly. And number 5, I want you to rebuild with intention. See, a divorce isn't just about protecting what is left, right? The crumbs, as many people call it. It's about creating the next chapter with purpose, creating the next chapter for both yourself personally and financially. Once again, I have seen people just feel obviously absolutely devastated both emotionally and financially after divorce, and with proper counseling and guidance by professionals. A couple years go by and they're on their feet. They're sometimes farther ahead than where they were before because they got this new lease on life. They want to work hard. They're very frugal about their money. There's all kinds of advantages. So don't think that life comes to an end just because of a divorce, either emotionally or financially. But again, the best advice I can give you, please develop a team. This is not something you want to do yourself. Your emotions are way too high and you're not thinking clearly. So bring in a great team to represent you, great attorney, financial advisor, CPA, so on and so forth, and you will survive and you will prosper. God bless. Have a great afternoon. We'll do it again tomorrow on the Jon Sanchez Show. Take care.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.